All right. So continuing lecture, we're going to now talk about what happened in 2007, known as the Great Recession, which predominantly revolved around racism and classism in subprime lending practices. And so we're going to talk about the history of that, what subprime lending is, what it looked like, and why it ultimately led to the Great Recession, this economic collapse that occurred in 2007. So we're going to start the conversation by first looking at the data of kind of where subprime lending started to take off and why that matters in the grand spectrum of things. So you'll notice that from 1997 effectively till 2003, subprime lending more or less stayed at about the same place, that about 7% to 4.5%, upwards to 8% effectively of loans were subprime loans, were these loans uh, with less favorable rates, less favorable interest rate, less favorable terms. And we'll talk a little bit about what those are in a second. But I just want you to notice for now, at least in terms of the data, that by 2004, they upticked significantly. Literally all of a sudden, they jumped from this kind of, 4, 5, 6, 7% rate that was consistent from 1997 to 2003 up to 18%, 20%, 21% of the housing market loans, right? So in other words, basically 1 in 5 loans were now subprime loans, dropping all the way back down to 8% or around where they were in 2003 when the housing bubble burst. You'll hear that term, the housing bubble burst. The housing market crashed and everything went topsy-turvy in the US economy as a result. Another way to look at it is just this chart. This is just a different way to look at the data, right? And so in this case, you're looking at the percentage of prime loans, which is that dark black line, and you notice that they dive starting in 2003, going into 2004, where they uptick over here on your other chart. At the same time, the subprime loans go up, right? So there's a very clear, correlation between the amount of prime lending going down and the amount of subprime lending going up. And one has to imagine why that may be. Why all of a sudden would there be fewer people qualifying all of a sudden for prime loans and all of a sudden more people qualifying for subprime loans? And that question and the answer to that question speaks loudly to kind of what was going on in this period. So first, before we get there, we of course have to answer the question, what is subprime lending? So subprime lending historically was constructed as loans that were going to be provided to people that were, seen as having poor credit history or a greater chance of defaulting on the loan. So they were originally designed to provide loans to people that might be more risky to loan to because they had bankruptcies or credit defaults in their history, or they had extended periods of unemployment within their history, long runs of unemployment that might suggest they might lose their job and not be able to pay a house note. People that were divorced. Divorce puts financial struggle on the individuals that are divorced because they don't have a joint income anymore, and so one person might be paying alimony or child support to another, and so the financial situation is often more precarious for people that are divorced relative to single people, or certainly to married people. And of course, if there's any indication of a medical history or potentially a lot of medical costs, medical loans effectively, they were much more likely to be, or the idea was a subprime loan was going to be offered to somebody in that situation or that category. The subprime loans themselves, to understand what they are, were usually characterized by higher closing fees. So if you were to be qualified for a subprime loan, or you were to be given a subprime loan, you're going to be paying higher closing fees relative to somebody that's getting offered a prime loan, sometimes in the neighborhood of 20% higher, 30% higher, things of that nature. So if your closing fee for a prime loan would have been, I don't know, $1,000, a subprime home closing fee could have been $1,200 or $1,300, sometimes 14, sometimes $1,500. It would have been higher. It would have been more expensive. The reason for this, of course, is because the bank's saying, well, we're getting more money up front, because then if you default, well, we still got more money out of you. So it's more lucrative and potentially more money making for us than potentially otherwise could have been. There's also higher interest rates, right? And the banks and their lending industry is going to say, well, this is to compensate for risk. We're charging you more interest up front. That way, if you default, again, we've made more money on this. And so it's less of a risk for us to lend to you because we get more money out of this. Even if you default, it's still a better situation for us. And of course, if you pay all the way through, it's a better situation for them as well, because they make more money over the course of the 20 or 30-year loan as well, as a result of you paying a higher interest rate throughout that, or at least through a good chunk before you might be able to renegotiate a better interest rate after your bankruptcy clears off your credit history, or whatever was causing that subprime, or supposedly causing that subprime lending offer from being given. And I say supposedly for a reason. You'll see why in just a second. It also came with, it was more likely to come with adjustable rates. And that's one of the kickers. I don't know why I'm having a problem breathing all of a sudden. Give me just a second. I will be right back with you. All right, let's try this again. So you can either get a fixed rate or an adjustable rate loan. Fixed rate is essentially whatever interest rate you're given. Well, it's not essentially, it is whatever interest rate you're given, say 15% interest rate, 12% interest rate, 8% interest rate, 5% interest rate, 3%, whatever it is, it's that same interest rate throughout the course of your loan. So for 30 years, you're going to be paying 3% interest on your home loan through the course of the 30 years or the 20 years or whatever your term, your length of your term is. An adjustable rate is a interest rate that can literally be adjusted almost from month to month, and in some cases the contract does allow for a month to month adjustment. And so an adjustable interest rate will, it could be 10% interest one month or 3% interest one month, and the next month it could be 15%, 20%, 25%. This is where you hear of ballooning interest rates, because that's often what would happen. It's not like it would go from 3% to 10% and then back down to 3%. It often was ballooning, that, you'd get a good interest rate. The bank would promise you, oh, well, we won't adjust it for a year or two. So you're going to get, 2 years at 5% guaranteed. But then after that, we can adjust it. And lo and behold, as soon as the 2 years was up, all of a sudden 3% went to 7%, went to 10%, went to 15%, went to 20%. And so whereas that family could afford that 3%, that 5%, maybe even that 7% or 10%, became much more difficult at 12% or 15% and impossible at 20%. And so those adjustable rates cause a lot of families issues, as they got to a point in which the interest rate being charged was now too high for them to be able to pay. So they could pay initially under the promised and guaranteed period in which it was being held at a certain rate, but they couldn't pay beyond that. So these kinds of terms were effectively aimed at maximizing return early, which was an insurance against default, as I said. That was the logic. Of course, that was the logic they were claiming to use. The reality was, however, that when we look at who they were subprime lending to, and what was going on, this logic doesn't pan out. In other words, what they were claiming they were doing, which was minimizing their risk for, otherwise risky loans, the reality was the people that ended up getting subprime loans, or the people that subprime loans were kind of sold to, were much more likely to be from particular backgrounds or particular identity groups. And so, hello, can you go, please? There we go. Bosian, Ernest, and Lee in 2006, Campine in 2007, Bean, Ellen, and Madar in 2008, and Pager and Shepard in 2008 all go to look at the data of who's getting subprime loans in this period. So they're either before the collapse in 2006 or right on the verge of collapse in 2006 to when the collapse happened in 2007 and the fallout in 2008, trying to figure out who's getting these subprime loans, why they're getting them, what's going on. Is it what the banking industry is selling us, which is, these are just more risky customers, and so that's why we're doing this? Or is this balloon of subprime loans and subprime rates, is there something else going on behind the sudden drop in prime loans and the sudden increase in subprime loans, and what could it be? And so all of these researchers, looking at different data from across the nation, come to the same conclusion. All the data is telling them that despite creditworthiness, in other words, if you're looking at a white family looking for a loan and a black family looking for a loan, that despite creditworthiness, in other words, that white family and that black family have the same occupational history. They're in the same kind of divorced or married category. They have the same ability to make the same down payment, the same income, et cetera, et cetera. Everything's more or less equal across the board. Black families and individuals were more likely to receive higher home loan interest rates. So to the degree that they were offered home loan, instead of being offered 7%, they were much more likely to be offered 10% or 12% or 14%. They were also more likely to receive a higher home refinance rates. So they were already homeowners, but they were looking to refinance to, paint their house, put a new roof on their house, to get some money in their pocket, whatever they were refinancing for. They were much more likely to be offered a higher refinance interest rate as well, and to receive fewer loan offers overall. And so, regardless, again, of credit worthiness, looking at all of these markers of employment history, income, wealth, ability to kind of put a down payment on a loan, Black families and Black individuals were much more likely to receive poorer offers relative to white families, regardless of being in an equal socioeconomic status. So when these researchers tried to figure out, well, why is this going on? Why is this happening? Why is it they're much more likely to receive these higher interest rate loans, these higher refinancing interest rates, these lower amount of loan offers overall, right? More likely to be offered subprime loans. What's going on there? Why is this happening? What they found was one of the things that was contributing to this was that there was a lower availability of traditional brick and mortar banks in communities of color. And what I mean by brick and mortar banks is literally that bank that you can go to, that Bank of America on the street corner, that Wells Fargo on the street corner, that Safe Credit Union, that Golden One Credit Union, that Schools Credit Union on the corner. There was much less likelihood of those banks having a physical presence in communities of color where Black people, Latinx people, and even Asian people were more likely to live. So in other words, one of the problems they had was that they didn't have physical access to banks that were able to provide them more opportunities, more potential offers, because you couldn't walk into a bank and get them, or it was more difficult for them to go to a bank. They would have to travel 10 miles down the road to get to that bank, or 5 miles down the road to get to the bank. And if you didn't have a car or easy access to travel, well, you were limited to what was available in your neighborhood. In some of these neighborhoods cases, there was no availability or very limited availability for brick and mortar. And to the degree that brick and mortars were available in communities of color in this time period, they were much more likely to be subprime lending institutions. So for instance, a prime lending institution in this period, a prime lending institution that went bankrupt and out of business, one of the few banks that actually failed along with the housing market crisis in 2007 because they had so many subprime loans and they didn't get bailed out like other banks did, was Washington Mutual. Washington Mutual had a lot of brick and mortars in middle income communities, upper income communities, disproportionately white communities, fewer brick and mortars in lower income communities and communities of color, particularly Black communities. And so if you were shopping for a home loan, if you were shopping for a good interest rate, you didn't have a Washington Mutual, or you were less likely to have a Washington Mutual in your neighborhood, which means you were less likely to gain access to a bank or a lender that would give you a better rate, because Washington Mutual was going to give you a better rate than a subprime lending institution, let's say like Long Beach Mortgage Company. And Long Beach Mortgage Company, particularly here in California and Southern California in particular, were much more prevalent, much more likely to exist during this time period. And they also collapsed during the housing market in communities of color. And of course, when they're there and they're saying, well, here's the loan offers available to you, they're loan offers with less lucrative deals. There are less options, higher interest rates, poor conditions. All of those conditions we talked about with subprime were the conditions they were being offered. Of course, they were aggressively marketing these high interest loans to Black families, which many people have said is kind of an example of reversal redlining. So instead of basically saying we're going to deny you a loan as a Black family, which was going on, as you recall, from the 30s to 60s, what researchers are saying is happening now is oh no, we're happy to provide you a loan, but it's going to be a high interest rate, lower value loan for you. It's going to cost you more. It's going to make your payments higher. It's going to suck your wealth and your income out of you in a different way. So instead of preventing you from being able to buy a home and build wealth, it's preventing you from building wealth in another way, which is, saving money, being able to get those better interest rates, which means you can invest in other things to build your wealth, the stock market, whatever, because now you are paying in these higher interest rate loans that are taking more of your monthly income to pay for these worse deals. Okay. Why does this all matter? Well, I think part of the reason why it matters is very clear. If you live in a neighborhood that has a Washington Mutual or a Bank of America or a Wells Fargo, that's much more likely to give you these better prime loans or prime interest rates, these prime loan options, you're going to get a better option. And of course, if you're living in a richer community or a disproportionately white community, we're much more likely to have the access to those types of banks that were doing them. Whereas if you were living in a lower income community, particularly a community of color, you were more likely to have access to the Long Beach mortgage companies, which were providing you the worst options, the worst rates. Well, the bigger trick that's going on here, just so you know, is it wasn't just accidental that Long Beach Mortgage Company ended up in lower income communities and Washington Mutual ended up in higher income communities. In fact, it was intentional. Why do I claim that it's intentional? Well, just so you know, Long Beach Mortgage Company was a subsidiary of Washington Mutual. In other words, it was owned by Washington Mutual. So you had a bank that was very intentionally sticking these brick and mortars under the Long Beach Mortgage Company name in communities of color and poor communities that they knew were offering them these poor rates, these worse rates, while providing middle income communities, disproportionately white communities, upper income communities, disproportionately white communities, these better rates through having their Washington Mutual locations in those communities. So the reason why Washington Mutual actually went under wasn't because the Washington Mutual side of the situation went bad. It was actually because the Long Beach Mortgage Company side of their company, under their company umbrella, went bad. That ultimately caused them problems. But notice here, right, we can't say, well, that's, because they made a bad decision and provided, loans to people they shouldn't have. If you go back to the data that I just said before, remember, we're literally saying that if they had the same history, the same background, the same exact socioeconomic situation, they were still much more likely to be receiving subprime loans if they were a family of color relative to a white family. They were much more likely to be getting these loans from Long Beach Mortgage Company relative to Washington Mutual, regardless of their socioeconomic standing or socioeconomic capability. Washington Mutual was very really, like many banks, participating in a very racist practice, intentionally so, by the very way in which they're positioning one type of brick and mortar in one community and one type in another, that ultimately led to a destruction of wealth and destruction of Black communities as a result of this intentionally targeting of these subprime loans onto Black communities, trying to make a buck and trying to effectively exploit lower income and disproportionately communities of color in this lending or loaning process that they were participating in the mid 2000s.